Long Beach CPA Blake Christian helps to ensure that CFOs, CPAs, tax directors and Los Angeles region business owners stay informed of the latest critical tax credit changes for corporations.
Blake, great to see you.
Very good to see you.
Well, federal tax rates changed in 2011, and what are the main considerations?
Well, with the deficit problem that we have in the U.S. and the fact that a lot of the liberal Democrats would prefer to keep the rates higher on the rich, there is a slight chance that the 2011 rates could jump up. But we're pretty optimistic that they will extend the Bush tax cuts for a couple more years until the economy recovers.
What are the categories and corresponding rates that will be affected?
Well, it'll be all rates. First of all, the ordinary tax rates for wages and things will jump from 35 to 39.6, which is a 16% jump. Capital gain rates would jump from 15 to 20%, which is a 1/3 increase. And then finally, dividend rates would jump from a low of 15% all the way up to 39.6. And then you have a state tax rates of 0 for the current year, and those could potentially jump back up to 55 and in some cases 65% of your estate.
What specific factors will push taxpayers into these new higher rates?
For the ordinary rates, it's for people making over about $350,000 of taxable income. But even the dividend and capital gain rates could kick in at fairly low income levels in the tens of thousands of dollars.
If taxpayers believe their personal tax rate will rise, what can they do by year's end?
For those taxpayers that think they're headed for a tax increase, they should actually accelerate income into 2010 so that they'll pay a permanently lower rate. And so we are advising some clients that are nervous about that to accelerate the income.
If taxpayers believe the rates will be extended, what should they do by year's end?
In the case of a taxpayer thinking that the rates are not going to change, then you go back to your standard tax planning opportunities, which is to defer income, taxable income, as far as you can. So if you can have your choice of taking a bonus in 2010 or taking it in January 2011, you want to push it out because you can push it out to the next tax year and wait and pay the tax for as long as 16 months. Whereas if you think the rates are going to go up, again, you'd rather accelerate it. And you would also want to accelerate your tax expenses into 2010.
What is the alternative minimum tax, and how does it impact year-end planning?
The alternative minimum tax is a system that runs parallel to the regular tax system that most people are familiar with. And where it kicks in is somebody that has a lot of capital gains or too many itemized deductions. And so you get kicked into this alternative system that's a lower rate, a lower tax rate, but it's on a bigger tax base. And so your tax can actually be higher under the alternative minimum tax. The good news is that when you're in the alternative minimum tax, you're at a maximum rate of 28% versus the current 35%. And so that's another situation where you actually are encouraged to accelerate income into that year because you could permanently save taxes. So we routinely will have people take ordinary income in the current year and actually defer expenses because sometimes they can't claim them or it's only at 28% rate.
Do you foresee any action in the coming years on tax simplification?
Tax simplification has been talked about for the 30 years that I've been in the business, and there's never been a year that it's gotten any easier. So I think with the deficit problem, and there are proposals right now on the table for more of a flat tax system, value-added tax system like Europe, and I think we will, maybe in the next 5 years, we're certainly not going to see in the next year any dramatic change in the basic personal and corporate structure.
And what about serious deficit reduction?
Serious deficit reduction is, I don't think Congress has the momentum or the congeniality to deal with that right now. There's certainly a little bit of talk about it, but I don't see them getting serious again for the next 5 years on the deficit.
Blake, thank you very much.
Thank you. Good seeing you.